Good afternoon, advisors, and welcome to the 5th webinar in our 2015 series. We continue to focus on all 4 generations of the Green family. We'll paint their portrait of risk and look at ways to protect the family and the family business. As with most families, there's drama. They're bold and beautiful. They're young and restless. We'll review insurance solutions tailored to meet their needs as they travel through the days of their lives. And they all have just one life to live. But that life will be filled with glee at times and passion at others. Through it all, though, and across the generations, they have a guiding light, a trusted team with you, their fee-only financial advisor, and LLIS, the advisor's insurance advisor. This month's series, as with each month, will last about 50 minutes. And the narrators of these hour-long series know that you'll have burning questions. And they're performed in front of a live audience, so feel free to be interactive. Type your questions into the question screen, and we'll do our best to answer them timely or at the conclusion of the show. Today's episode is being recorded and will be posted to our website within a week in case you missed a pivotal moment in the story. And throughout 2015, loyal fans will receive 10 CFP CE credits, 1 for each month. The more you tune in, the more you know. Today we focus on Ben and Carl, the father-son team with their own small business. And then in September, we'll continue to focus on business owners with some more advanced solutions. We have 2 narrators today. Your first narrator is Kathy Bilodeau. She's our disability insurance specialist, and she'll look at how to protect Ben and Carl and their business from loss of income due to a disability. Keith Maurer, her co-host, will give you some life insurance solutions for businesses. And now, let's get down to business with Kathy at the mic.
For our 2015 webinars, these are your clients, the Greens. The Green family is 4 generations, and we're going to follow them as they move through different phases of their lives with different financial needs as they seek to protect against uncertainties and to deal with upturns and downturns. They're a pretty cool family, actually. Let's get to know them better. As you may recall, in last month's episode, we focused on Barbara and her interest in long-term care insurance. She wanted to make sure that her carrier had a case coordinator, and she also looked at flex credits. In addition, she considered some annuities such as the hybrid, the immediate, and the deferred income annuity. If you didn't tune into last month, be sure and check out our website where you can click on past webinars to get caught up. So here we have the Green family tree, and as Dina mentioned, today we're going to be focusing in on Ben and Carl. But before we get started, let's talk a little bit about our characters today. First, we're going to talk about Carl. Carl is 34. He's married to his lovely wife, Jenny, and they have a wonderful daughter named Diana. Carl works for his dad, Ben, in their family business, and one day Carl hopes to take over the business in the future. Carl has a good income, but no retirement plan. And he's considering an executive bonus plan. And Jenny, who he's married to, is an elementary school teacher, so she has nothing to do with the family business at this time. So let's talk about what the business is. It's called the Flying Carpet Incorporated. Ben, who's 55, owns Flying Carpet, and right now it's valued at approximately $5 million. Flying Carpet supplies carpeting to a well-known airline in Georgia, and Carl, his son, is Ben's successor, and Carl plans to purchase the business over 10 years. Right now, he's purchased 25% of the company's stock, and the final transition will be complete in approximately 7 years. They have 20-plus employees, and they have one key person who's considered their superstar salesperson. Now let's go over a little bit about our top 3 executives. The first one, Ben, who's the owner, has approximately $475,000 in income. His son Carl, the VP of Operations, is earning approximately $250,000, and their superstar sales rep Kelly is earning about $300,000. Now, as a small business owner, Ben has elected to provide all of his employees with a group disability plan that provides 60% of their pay with a monthly cap of $5,000, and it's employer paid, so Flying Carpet would be paying for this benefit. And as a small business, Ben has had to deal with all types of issues and needs. So one of the things that he had to be concerned about is there's 28 million small businesses in the United States, representing over 99% of all employers' firms. And the disabled worker population on Social Security increased by 5% from 2011 to 2012. And also, did you know that 69% of the workforce does not have disability insurance? In addition, over 40,000 businesses closed due to an owner's death between from 2013 to 2014. Now, to address various issues that a business should consider is my great co-host, Keith Maurer. Take it away, Keith.
Thank you, Kathy. I hope everybody can hear me. If not, I'm sure somebody will click up on the little question answering things there. So anyway, let's go on with our situation. What we're going to talk about today is the business. We've talked about where we're focusing on the family. It is their family business that we're talking about today. We're going to talk about key person from a life insurance point of view. We're going to talk about salary continuation from a life insurance point of view. We're going to talk about a buy-sell from a life insurance point of view. And then we're going to shift back into disability. And we're going to start out, the transition is going to be how multi-life discount with disability. And that's key to the transition because Kathy's going to talk a lot about how by having 3 or more people on a plan, there's a lot of discount in all the other plans as well, not just their individual disability. And then a new product, which has just come out, is key person disability from a disability point of view. Remember, I'm talking about key person from a life point of view. We'll talk about business loan with a disability. And finally, we'll talk about business buyout from a disability point of view. So let's get started. We're going to talk about key person from a life insurance point of view. What we're focusing in on is how to protect the small business, your small business clients. You know, we've talked a lot about them themselves, but we're protecting the business. And I think that's important because in this situation, we're going to have many times that the business is the beneficiary because what we're focusing in on is protecting the business. We're going to talk about that from a key person point of view, salary continuation, then succession planning, which ends up being a buy-sell. So who is a key person? What is a key person? From a key person's point of view, it's typically someone who is critical to the business, to the livelihood of the business. It can be from various skills. It may or may not be an owner. Many times we think it's the owner, and probably in the very small shops it is the owner. They are the business. But in this situation, it's more than just the person who can run the business and who knows how to provide the capital. Responsible for business management decisions, is usually highly paid, almost always highly paid. If they're a key person and not being highly paid, there's usually a question from the insurance company's point of view. If it's a key person, why aren't they highly paid compared to everyone else in the business? They have a significant impact on the business's income, which we will see in a second, and has a special rapport with the customer or with creditors. Now, in our situation, the key person is going to be Kelly. We look at a business and we tend to buy insurance on the building, we buy insurance on the supplies, we buy insurance for somebody slipping on the sidewalk outside when it's icy outside. But what is their most valuable asset? Well, most valuable assets in most small businesses are people. In this situation, it is Kelly, who we're going to focus in on as a very valuable asset to the Flying Carpet. The policy is going to be owned by the Flying Carpet because that's who we're protecting here. We're not protecting the key person so much as we're protecting the owner if something happens to the key person. Therefore, the business is also going to be the beneficiary. The premiums are not deductible, and it's usually term. And why is it usually term? Well, from a key person's point of view, the value of them as a key person to the business usually has an ending point, retirement, death, of course, but usually isn't ongoing, as we may see in some of our other examples where we may not want to use term insurance. But key person is almost always term insurance. So let's focus in on Kelly. She's their top salespeople. They actually have a total of 4 salespeople, but Kelly actually generates 50% of the sales. She's the one sells as much as the other 3 combined. She has a base salary, which is very similar to the other salesmen, but she has a great bonus because she does do so well, and so she makes a total of $300,000. Now, Kelly is 42. We're going to call her preferred, not preferred plus, but she may be. But for now, we're going to be preferred, second best class. She makes a total of $300,000, and we're going to purchase $1 million 20-year term on her. Why $1 million? Well, from an underwriting point of view, you usually look for a key person to someplace between 3 to 5 times their total salary. In rare situations, you can get up to 10 times, but you really have to defend that decision from an underwriting point of view. But ballpark, what they feel comfortable with is 3 to 5 times. That gives you time, the business, time to find the replacement, to make modifications, to train, to do whatever you need to do. So in a 3 period, so it's 3 to 5 times salary. The business is going to be the owner. The flying carpenter will be the owner. The flying carpenter will be the beneficiary, and they will pay the premiums. And in this situation, Kelly is simply the insured. So, key person, simple, straightforward. You protect the business. But let's go on to sort of build on that, which is called salary continuation. Now, salary continuation has many names. You may have heard it as golden handcuffs. You may have heard it as deferred comp. You may even call it sometimes a private pension and all that kind of stuff. But there's 2 parts to this. One of them is it's a written agreement. This thing our presentation that Kathy and I are doing, it says, get it in writing and then fund it. It's important to get this in writing. And all of these agreements, pretty much, it's a legal document drawn up usually by lawyers. Yes, we do have sample agreements that you can read and look at, but we strongly, we do not practice law, and we suggest you get an agreement in place. And then you need to think about funding it. The agreement sort of puts the company on the hook, so to speak. Doesn't say they have to fund it. They may have to fund it at the end when the person dies or on their own, but we're going to talk about the agreement and the funding. So what is a salary continuation? First of all, the difference technically between salary continuation and deferred comp is that Kelly's not giving up anything. She's not deferring some of her earnings. She's not saying, I don't want to take it now, give me a better deal at the end. So it's all a plus for Kelly. What it says in sort of boiled down, Kelly, if you die before retirement, I, the company, the flying carpet, will pay to your beneficiary $100,000 a year for 10 years. And if you continue to work at least until age 62, which is 20 years, or later, we, the business, will pay you $100,000 for 10 years. And by the way, it works sort of as a combination, is that if she retires and she gets 5 or 6 or 7 payments and there's still 3 or 4 more to go, it would go to her beneficiary. So that's what the agreement says. Now, it's not funded yet, but that's what the agreement says. That's what the salary continuation says. How do we want to fund it? Well, we're going to fund it with a $650,000, and I'll get to why that number in a moment. Low load, meaning no agent commission type UL contract with an option B, which means you get the cash values and the death benefit, and we're going to pay that over 20 years, the 20 years that we assume Kelly is going to be working and generating a lot of good income for the business. The option B is because if she dies, then the company's not only going to get the $650,000 to fund the 10 years of $100,000 payment, but they will also, in essence, sort of return all their premiums paid. How will that happen? Because with a low load contract, as you will see, the cash surrender value is very close to equaling the premiums paid even the first year, and very quickly actually exceeds it somewhat. But so the design here is always show you that the company really is going to recover their costs if she dies, if she leaves, or if she retires. But that's the way we're going to sort of look at how we're going to fund the salary continuation program. There was a question about what do underwriters look at, 3 times salary, 3 times salary and bonus. It would be total compensation, just simply because the company chooses to say that you're compensated because of some formula based on bonuses. They will take that into consideration, absolutely. So this is now sort of before retirement. Remember, before retirement, if something happens to her, it's going to go to her beneficiary. So what happens? We have this policy. It's going to be owned by the business, the Flying Carpet. They're going to pay the premiums. They're the beneficiary of the policy. And should something happen to Kelly, remember we're now talking about before retirement, and we're assuming now Kelly is deceased, then payments from the company will go to Kelly's beneficiary, who's the man on the right here, George. He will get $100,000 a year starting the year of Kelly's death for 10 years. It is taxable to him, and so the company here will pay the beneficiary because Kelly's deceased. So, why is that a good deal for Kelly? Well, it's, not necessarily directly a good deal, but if she wanted to have coverage so that if something happened to her, if this plan wasn't in place, she would need to buy some insurance, possibly term insurance, on herself so that George would have some money at her death. In essence, while we're saying she is nothing but the insured, she really is. She's getting a benefit indirectly in that she does not need to buy as much personal insurance as she may feel she needs, simply because this plan is in place. Remember, there's a contract. There's a contract that says this is going to come to her beneficiary. So, in a way, she's gaining on this too. But picturesquely, how does this work? The Flying Carpet up here is going to pay the premiums. And the premiums, which is cash, is going to go to the insurance company, and in back, they get cash values. For those of you who are accountants and do accounting for your clients or whatever, you're taking a liquid asset of cash out and replacing it with another liquid asset, cash values. There are no surrender values. In essence, very little to no actual assets leave the corporation. Premiums go to the insurance company. Then when money coming back, either in the form of cash values, which we'll see in a minute at her retirement, they will come back income tax-free when done properly, and there are no surrender charges, so it's a high-value contract. And if she dies, when she dies, because she will die, the benefits come back to the Flying Carpet, also income tax-free. So at salary and continuation time, payments are made because now money has gone from the insurance company back to Flying Carpet. They will take that money and pay it either to George if Kelly dies, or we'll pay it to Kelly if she sticks around long enough to wait till after retirement. All of that is tax deductible to the Flying Carpet. So that's sort of how the process works. Follow the money. So we have a salary continuation agreement. It says it's going to pay $100,000 for 10 years. We're going to fund it now. We got the agreement that says that. Now we're going to fund it with a low load cash value contract. The cash values are an asset on the book. It's a liquid asset. They have access to it, same in the way they do any other of their liquid assets. The values accrue on a tax-deferred basis. Money coming out is income tax-free when done properly with withdrawals up to cost basis and policy loans. The payments to Kelly or to Kelly's beneficiary are tax-deductible, which is critical. And the cash values, as during this time of accruing, does not count toward retained earnings. Those of you who do accounting for your small businesses who want to try to build up a slush fund or a war chest or whatever have a hard time doing it because this is a nasty, nasty tax if you ever get a retained earnings tax. for a company who just simply because they're making money and choose not to pay it out in dividends or salary or some way. So it doesn't count toward that. So it's the big reason why some companies who are small businesses can't afford to accrue a whole lot of cash any other way do use low load cash value life insurance. Now, what happens at retirement? Well, now we're going to pay them out. Here's the numbers for those of you who like numbers. If you look up here, we're going to pay $100,000. We're assuming the corporation is a 35% tax bracket. So net after tax, it's going to cost $65,000 to pay out $100,000 tax deductible. So we're going to have this number right here. $65,000 is going to relate to here when we start taking money out. This is income tax free. With a $65,000 income tax free is what it costs to pay $100,000 out tax deductible. And also, how do we get the $650,000? Well, that's $650,000 times 10 is $650,000 death benefit. Option B is plus all the cash values, which is almost equal to or exceeds the premiums paid. Now, we've talked about, if she dies or she retires, what happens if she leaves? Well, since we can all multiply times 10 easier than we probably can any other number, if after 10 years they've paid $24,000 for 10 years, the business has paid in $240,000. Let's say she just ups and leaves. She gets a better deal. She doesn't want to work anymore. She wins the lottery. Who knows why? She just leaves. What happens to the company? Well, they get the cash values. They put in $240, they get $280 back. So it's not a bad deal, they didn't want to lose her, but if they're going to lose her anyway, at least they're going to get some money back. Now, when she retires, they'll start taking money out. They'll take money out for 10 years, $65,000 each year, age 63, 64, whatever, in 30 years. Now, they stop taking money out, but they still own the policy. So her normal life expectancy is age 87. That's 45 years from the time they purchased it. On a projected basis, I do understand. There is a death benefit still of $612,000. If she dies at age 100, there's $481,000. Why is $480,000 a significant number? How much premiums have they paid in a long time ago, but how much did they pay? $24,000 times 20 years, or $480,000. Yes, there is time value of money. I understand all that, but most small businesses keep their cash in the right-hand drawer of their desk. What's in the right-hand drawer of their desk? Their checkbook. And how much are they earning on their checkbook? Nothing. Most small businesses don't do what you should tell them to do, sweep their account and invest it in money markets and all that kind of stuff. So time value of money, at least in today's world, is not that big a deal. You just can't get it fast enough in a small business. They eat cash for breakfast, lunch, and dinner. So they're not going to put it someplace where they can't get their hands on it. So sort of a salary continuation, deferred comp, why am I talking about this? Am I expecting you to go out and show this? Probably not. Some of you might. Some of you may look at it for yourself. But in the last month, I've seen 5 different financial planners say, look at what my client is being proposed. Can you tell me what it is? And 100% of on all 5 of those times, it was a form of salary continuation deferred comp. They packaged it with funny names, but it was all the same thing. It was just exactly this. So we've talked about keepers, and we talked about salary continuation. Now let's talk about a buy-sell. What is a buy-sell? Well, buy-sell is a contract. Get it in writing. Contract that basically says that the owners who have the stock now must sell. In this situation, we're going to do a business buyout, and the business must buy the shares at agreed upon price. Kathy's going to talk a little bit about business evaluation. You should have a business evaluation. See, I had a question on my last one. Could you please explain how if we give her $100,000 tax deductible, why does it only cost $65,000? Because $35,000 you're in the tax bracket, you get it's a deductible item, so you protect other assets. So a deductible item is less expensive to you than a non-deductible item. Okay, going back to buy-sell. We have, right now, Ben is the owner. He owns 75% of the business, and it's a $5 million business, so it's $3,750,000. Carl already owns 25%, so he has $1,250,000 of assets. Now, what is the plan? The plan is that Carl is going to buy 5% from Ben every year for the next 10 years. So each year, Ben would be 5% less, Carl would be 5% more. Let's go ahead 10 years. Ben is always going to keep 25%. He's never going to be totally out of the business. He can be a consultant. He's going to keep his finger in the pie. He's just never going to sell it all to Carl, and Carl's okay with that. But in 10 years, Carl's going to be a 75% owner because he will have bought 50% of the shares from Ben. So now the position is just reversed. In 10 years, Ben will have own only 25%, or $1,250,000, and Carl will own 75% of the business. And assuming the business values does not change, it would be $3,750,000. That's the what. But how are we going to fund it? With a buy-sell, and we're going to do a stock redemption. I'm not going to go into cross-purchase and all that. I can at another time, but not the point today. We're going to do stock redemption. What does that mean? It means that the business owns this insurance, the business is the beneficiary, and when a person dies, the business will buy the shares from the estate of the shareholder that died and will then redeem or retire the shares. Premiums are not deductible. This is not a tax-deductible or qualified plan. And death benefit, however, does come back income tax-free, which is good to the carrier, good to the company, the Flying Carpet. And the estate, at least under current law, gets a stepped up in cost basis. So that, let's say Ben can prove that he put in $100,000 to start this business, and it's now worth, his shares now worth over $3 million. When he dies, he gives whoever he gives his beneficiary to, they get the shares worth $3 million, and their stepped up in cost basis is $3 million, so it's really $3,750,000. And so when it's bought out, the estate does not have to pay any gain tax because they get the stepped up in cost basis. So it's a great transaction for everyone involved. How's it work? Well, with the buy-sell, we have the business, the Flying Carpet. They're going to buy the insurance. They have a contract with both Ben and Carl. It's important that you have to have most companies insurance companies like to have a buy-sell with all the shareholders, especially in this situation where there's only two and there's 75-25, and that's going to change over the next 10 years. So it's a contract. Has nothing to do with the insurance at this point. The insurance is not the contract. There is a contract to buy-sell. The Flying Carpet then pays premiums to the insurance company. When one of the shareholders dies, then the money goes, the death benefit goes to the Flying Carpet, the business. They get all the death benefit. Now, oh, poor Ben, he's going to rest in peace. And so what happens? Well, the Flying Carpet just got the money from the insurance company. They're going to buy the shares from the estate and buy the stock back to the Flying Carpet and redeem the shares. What happens when you redeem and retire shares? Well, what happens to good old Carl? He didn't get any more shares, but he's a much bigger owner because now he owns all the outstanding shares. He's, in essence, 100% owner simply because they retired Ben's shares at the time. Now, how do we fund it? Well, we need to fund, because Ben could drop dead tomorrow. We have $250,000 of term insurance, 10-year term insurance, because over the next 10 years, that's how much he's going to sell to Carl. So we're going to buy a 10-year term for $2.5 million on Ben, and since he's going to keep 25% of it forever, we need to buy a $1,250,000, and we're choosing to buy a guaranteed lifetime UL, and we're going to pay for it over the next 10 years. Why the next 10 years? Because that's when Carl still has Ben to help him run the business, and hopefully will not need to spend any extra money to replace him and that kind of stuff. So we want it all done by the time that Ben really sort of is out of the picture. And we need to worry about Carl, because, you know, sometimes our plans just don't work out, and darn, you know, the wrong people die. it's not unlikely that Carl could die. So then what's Ben going to do? Because now the company still says that they have to, the company still needs to buy out the shares, and now the shares happens to be in Carl's family. So we need a 30-year term. We're going to buy a 30-year term on the $3,750,000. If something should happen to Ben and they redeem the stock, then we'll need to buy more insurance on Carl, because he will then own all of it, $500,000. But for now, the picture is that over the next 10 years, we'll cover Ben should something happen to him, and then we'll have Carl covered for the next 30 years, and that's probably long-term planning for everybody, even for me. So we've talked about the key person. We've talked about the salary continuation. One thing I didn't mention about salary continuation is that because it is non-qualified, meaning you don't get to deduct the premiums, it's a non-qualified plan, you can discriminate. And that's many reasons why you put in salary continuation. If you just give Kelly a big raise, you change the formula so she has more of a bonus, you're either going to get too much or screw up the salary system or the bonus system for the other three. It just sometimes doesn't work. So this is a way that you can pick out a person that you want, the business wants to, and that's why many times it's called gold handcuffs. You give them something that if they leave, it stays with the company, and you don't have to give it to everybody else, but it holds them to you. So now we're going to switch subjects. I'm going to give you back to Kathy. We're going to talk about disability. Kathy, take it away.
Thank you, Keith. Okay, we're going to start our disability discussion with individual multi-life disability as our foundation, and then build upon that for other types of disability protection. But before we get started, did you know that the average long-term disability claim is 2.5 years long? And did you also know that 1 in 2 people will experience financial troubles in less than a month? And that 90% of disabilities are due to an illness and not an accident? That's why disability insurance is also known as income replacement insurance. It does exactly that. It replaces your client's income if they become disabled and can no longer work. So let's talk about income replacement insurance. As you know, Keith talked about protecting Carl and Ben if they were to die. But what if they were to become disabled? Since the company offers a group disability plan of 60% to $5,000, we wanted to focus on a supplemental, or what you might call a gap plan, for the top 3 executives. And because there are 3 or more, we can offer what is known as a multi-life discount, which provides a 20% discount on all the plans I'll be discussing today. In addition, Kelly, who is a female in our group, will be getting unisex rates. And I'll be talking about that in just a minute. But let's talk about the 3 top executives. We have Ben, Carl, and Kelly. Ben at $475,000, Carl at $250,000, and Kelly at $300,000 of income. Now, that income does include not only their base salary, but their bonuses. And most group plans do not cover bonuses and or commissions. In the Flying Carpet, they will be maxed out at $5,000 a month. So we were able to provide a supplemental plan for Ben at $16,000, Carl at $9,700, and Kelly at a little over $12,000. Now, over a year, the payouts would be $257,000. We got to that number by taking the $16,000 and the $5,000 and multiplying it by 12. And the same goes for Carl. We'd be able to provide him with $176,000 and Kelly with $208,000 a year in the event that they became disabled. Now, the annual premiums for each of these would be $13,000, $4,600, and $7,800 for a grand total of $26,000. But wait, with the multi-life discount, we're able to give a 20% discount to each one of these. So Ben's premium goes down to $10,000, Carl's down to $3,700, and Kelly's down to $6,200 for a grand total of $5,200 a year in savings. Because now with the 20% discount, instead of paying $26,000, they're only going to be paying $20,000, a little over 20 or just under $21,000 in plan or in premium. Now, for those of you who are not familiar with the multi-life discount, it's available when 3 or more employees with a common employer purchase coverage. In addition, female rates are written as a unisex rate under the multi-life, which is an additional savings for them. And we're able to apply this today if Ben wants a disability plan and Carl and Kelly don't apply. So in other words, Ben could apply for disability insurance and he wouldn't be eligible for the discount. But within 1 year, if 2 or more employees, in this case Carl and Kelly, applied for disability, Ben would retroactively get his 20% discount. In addition, Carl and Kelly would automatically get their 20% discount. In all the plans I'm presenting today, we will be utilizing the 20% discount. And a nice feature about the multi-life discount is if any one of them were to leave the firm, they continue to retain the 20% discount. So let's talk about key person. Did you know that half of business owners have no disability coverage for themselves or for their key employees? And as Keith mentioned, there is a carrier now that does provide a disability solution for your key employees. And why is it important to consider disability insurance for key people? Well, because the likelihood of your clients having a disability before death, before age 65, at age 30 would be 4 to 1. At age 35, it's 3.5 to 1. And at age 45, it's 2.1 to 1. Now here's some statistics that illustrate the reason that disability insurance is equally important as life insurance. If you look at the statistics here, disability claims are going up where deaths have decreasing. The reason for that is your clients who might have a heart attack or a stroke continue, because of medical technology, continue to survive, but they may not be surviving and thriving like they were before they had it. Therefore, they would be possibly going on a disability claim. Hence the reason that the claims for disability are going up. So before we get started on a key person quote or illustration, let's review again what Keith mentioned. What would be considered a key person? Someone who's critical to the livelihood of the business, in this case Kelly, because she is their key person that generates most of the sales, and I think Keith mentioned 50% of the revenue. She's not an owner. I don't know that she's responsible for a lot of the management decisions, but she certainly is highly compensated, and the income is significantly impacted on her performance, and she definitely has a special rapport with her customers. So key person disability insurance is designed to protect your small or medium-sized businesses from any loss that might be incurred with a total disability. And this is important. With key person disability, your client has to be totally disabled. In other words, there is no residual benefits on a key person disability plan. Now, some occupations that might appreciate this particular coverage are medical practices, architects, attorneys, salespeople such as Kelly. And what are some of the common uses for that disability insurance? Well, they can use it to offset recruitment costs, in this case to replace Kelly. You can use it to provide for temporary staffing needs and revenue replacement. The key thing to remember about disability insurance for key persons is the benefits cannot be assigned to the key employee. In other words, they're not assigned to Kelly. So how does it work? Well, the employer pays the premium. In this case, it would be the flying carpet, and the flying carpet is the owner of the policy, and they're insuring the key employee, in this case, Kelly, in the event she becomes totally disabled. So the employer receives the benefits, flying carpet, tax-free, in the event that Kelly becomes totally disabled. Now, the way key person works is it's based upon a calculation of 2 times the employee's earned income up to a maximum of $500,000. And again, the benefits are received tax-free. So we have Kelly here, who's age 42, and as you recall, her total income is $300,000. Now with a key person plan, the elimination period that they will receive any type of benefits between 0 and 90 days will be 0. With a 90-day elimination period, between 91 days and 365 days, we structured it so that Flying Carpet would receive $20,000 a month. And that would be a total benefit of $180,000. Then, at the end of 365 days, Flying Carpet is going to get a lump sum of approximately $500,000. If you combine the $180,000 with the $500,000 lump sum, you're going to be looking at a combined benefit of $680,000. Ben and Carl would have to go out and find a replacement for Kelly, and they may be more than one person to replace Kelly since she was so great at her job. And the annual premium for Kelly's for Kelly's key person is just under $5,000. But again, we've got that 20% discount that we can apply, so Kelly's premium is coming in at just under $4,000, a total savings of $998 a year. And if Kelly stays with the company for 20 years, at age 62, the Flying Carpet would have saved almost $20,000 on her key person disability plan. Now we're going to talk about business loan. Ben, as you may recall, the owner, he's decided to expand the Flying Carpet and he wants to purchase some mill equipment. But before we get started on that, I want to share some interesting statistics. Did you know that 23 million outstanding small business loans are valued over at $587 billion? And that did you know that bankers are refusing to lend businesses in certain industries, such as restaurants, any type of money if their revenue falls below $2 million? And small firms employ half of our private sector workforce. But lucky for your clients, if they want to take out a loan, we could provide them with a business loan protection rider. That's what the Flying Carpet decided to do, since they decided to take out a loan for $500,000 to expand their mill. So if Flying Carpet wants to make a loan payment in the event Ben becomes disabled, it will do that. If you want to help secure a loan, there's a feature for that too. The Flying Carpet is only taking out a loan for $500,000, but the business loan protection rider would cover a loan up to $2 million, including principal and interest, and the benefit period would go to age 65 or the end of the loan, whichever comes first. And if you want the benefits assigned to the financial institution, there's a feature for that. And this one's really important because by assigning the benefits to the financial institution, the bank would look more favorably upon giving the Flying Carpet a loan, since they know that regardless whether Ben becomes disabled or not, they're still going to get their loan payment. So here's an example of some of the things that you could take out a loan for, and we could use the loan protection rider plan with. In this case, Ben decided to purchase some equipment, or you could use it to expand your practice, you could do some facility renovations, or if you took out a loan to increase your working capital or expand your inventory, that would be doable also. So here's a breakdown of the loan coverage that we took out for Ben. He took out a $500,000 loan and he was going to pay it off in 10 years. So the business insurance is taken out on Ben, and it would pay $4,000 in the event that he became disabled. And we want a 30-day elimination period on this because we don't want it to stretch out 90 or 180 days. We want to make sure that business loan is being paid to the bank as quickly as possible. So if we're going to take it out for 10 years, the premium without the multi-life discount would be about $2,700. But because we're providing that 20% discount, it's only going to be $2,166. And keep in mind that while he's disabled, the premiums for this particular plan will be waived. So on an annual basis, with the 20% discount, we would be saving approximately $541. Disability buyout. As the title of our presentation mentions, you need to get it in writing and fund it. Well, that's especially important with buyout insurance. But before we get started, I needed to share with you that the #1 financial priority for most business owners is to protect their business. And also, 79% of 3-owner firms will have at least one owner out for 3 or more months. And 64% of business owners have absolutely no exit plan. Now, what would be the impact of a disability on a business owner? Well, The inability of a partner to continue working due to a serious illness or injury is a serious matter, one that is more problematic than death, as a matter of fact. Now, Ben's advisors, who are very good advisors, they talked to him about what would happen if he or Carl were to become disabled. Would they want their wives to have to sell the company? Carl's wife is an elementary teacher, and she knows nothing about the carpet business. So they asked them, should you be asking your clients what would happen if you died or if you became disabled? Do you have a plan for your business if you were to become disabled? It can and does happen to business owners. And the consequences of not planning affect not just you, but the business, not just affect you as the business owner, but your family, your partners, your employees, even your suppliers and customers. Enter a solution, a buy-sell agreement funded by disability insurance. What type of disability insurance, you say? Well, it's called disability buyout insurance. And what disability buyout insurance does is it reimburses the business for the purchase of an owner's interest in the event that they should become disabled. So what it does is it helps the business survive a partner's departure, allowing the other owners and their family to receive full value of the business. And in the case of flying carpet, it could prevent a competitor such as Mohawk or Shaw to come in and buy the disabled owner's business interest in the firm and force out the active owners such as Carl. So we had to ask Carl these questions because having two or more owners can complicate things. So that's the purpose of a buy-sell agreement, to lay out the what-ifs. The first one would be, how will the value of the business be determined? By a formal valuation, of course. How is the disability defined? Well, since Carl and Ben and Kelly all took out a disability plan, the disability insurance company that they took it out with would be able to determine if they're actually disabled or not. Will the disabled owner continue to be paid during his disability? In this case, Ben would be, because Ben not only has the group disability plan that pays him $5,000 a month, he would also get his individual disability plan that he purchased. And how will the healthy owners pay for their share of the business owner, the disabled business owner's share of the business? Well, if they purchased disability buyout insurance and had prepared a buy-sell agreement, remember, get it in writing and then fund it, which is the title of today's presentation, they wouldn't have any problems and all these questions would be addressed. But keep in mind, whenever you have a business and it's owned by one or more or two or more owners, they all have to be on the same page and they all have to be purchasing the buyout insurance. What are your options if you don't have buyout insurance in place? What would happen if Ben were to become disabled and he wanted to have his share of the business? Well, Carl would have to wait for the business to build up some sort of cash reserves and then pay Carl. He could possibly go to a bank and borrow the funds, but the bank may not allow that when the key person, Ben, is disabled. Sometimes they don't look favorably upon loaning because they're not quite sure that Carl would do an adequate job of running the business. Or they have the option of spreading out the payments from future earnings. But with a disability buyout insurance, you can fund the disability buyout by an insurance that would provide Ben with a monthly benefit, perhaps a lump sum, or a combination of both. Now, the soap opera portion of today's webinar is, here's Ben as we know him. But like any good soap opera, we have to fast forward 5 years, and there's always death. And in our case, it's poor Ben. But just like the soaps, don't be surprised if he comes back to life next month. Now, 5 years later, Carl's 39 and Kelly's 47. Now upon Ben's death, their life insurance and buy-sell works just like it's supposed to, because that's what Keith told them that they needed to do. And Carl is now 100% owner of Flying Carpet. So, as we continue the soap opera portion of today's webinar, Carl and Kelly decide that Carl has decided that Kelly's dedication to Flying Carpet needs to be rewarded, and has been leading up to this. So he's offered to make her a 25% owner of the flying carpet. So now we're going to look at some disability buyout insurance for this new partnership. So here we have Carl. Again, he's 5 years older, so he's age 39, and his buyout benefit is going to be $1.5 million. In the case of buyout insurance, we're going to increase the elimination period. And the reason for that is simply because we don't know how quickly Carl is going to be coming back to work. It might be 90 days, it might be 5 months, 6 months. So before we buy out, we want to make sure that he's definitely not going to make it back. So we chose a 365-day elimination period for the lump sum. And the annual premium on a plan like this is $92.35. But with our 20% discount, it drops to $64.65. So we're saving approximately $2,700 with this 20% discount. Now, we weren't able to get them to the full valuation of the business, which is now a great amount. It's risen to $6 million, simply because insurance companies' maximum disability buyout insurance for Carl is $1.5 million. So that's what we've illustrated. So we'll use that option, and then as you recall when I talked about what are the options without disability insurance, you could go to the bank and borrow, we could use cash reserves, or we could actually do retained earnings. We're going to spread out the remainder of the payments from future earnings to get to the total $6 million if either Carl or Kelly were to become disabled. So let's look at his partner, Kelly. Kelly's now aged, she's 47 years old, and she owns 25% of the business, or $500,000. And again, we did the same thing. We did a 365-day elimination period. And her premium without the discount is about $5,500. But with the 20% discount, it's running about $4,400. And even though Ben is no longer living, the multi-life discount remains on their policies. And again, if either of them should leave, they get to keep the discount. And in this case, we're saving approximately $1,100 on the disability buyout plan. So let's review what we went over today. We talked about disability insurance, which is a policy that provides monthly benefits to help pay daily living expenses in the event that your client becomes disabled. And we talked about key person insurance. This is really important if you have a superstar salesperson such as Kelly, or perhaps a tech person that would be difficult to replace. This benefit, like the disability buyout, can be paid in a lump sum, a monthly benefit, or a combination of both. And the business loan protection rider. This is the one that provides the monthly business loan payment in the event that the client becomes disabled. And then lastly, we talked about the disability buyout. This benefit is ideal for the disabled owner since he or she won't have to wait to be reimbursed for their share of the business. We even have a company that will provide a business valuation of your client's business at no cost. And this is a huge benefit because a typical business valuation can run $5,000 to $20,000. So let's recap the impact of what the disability or what the multi-life disability discount can do. We talked about supplemental disability for all three of our top executives. The total premium for disability was $26,000, and then with the discount, we were saving them $5,200. For the key person insurance on Kelly, we were able to save them $998, and on the business loan protection for $500,000 that Ben took out, we were able to save them $541. And then lastly, on the business buyout between Kelly and Carl, between Kelly and Carl, we were able to save them almost $4,000. So all total, in 1 year, the total annual savings is over $10,000. So get it in writing and then fund it. As you can see, we covered a variety of different topics today, but the most important thing that you should take away from today's presentation is to get it in writing and then fund it. And now back to Keith, my co-host.
I just want to say one more thing. If any questions that we did not have a chance to answer, and there's a couple I see on mine that I did not have a chance to answer, we will individually email you the full answer. I'll try to get mine out tomorrow, Kathy, maybe tomorrow or the next day if we have any other questions. So even though your questions were not answered on the screen on live, we will get to them, we promise. But stay tuned for next week's going edition of As the World Turns. Next month, we will find out about the toughest part of the conversation of planning for children with special needs. And our great host will be narrated by none other than Mark Maurer. But did you know that children is hereditary? If your parents didn't have any children, neither would you. Also, did you know that you can register today for our 2016 Insurance Academy? It is February 4th and 5th. It's here in Tampa. And for those of you who are up north, and especially anybody in Boston who can remember all the way to December and February of last year, that little snowman is still probably sitting out there because I don't know if all the snow was ever melted up there yet. Also, for those who are going to the Garrett Annual Retreat next week, almost next week, a week and a half away, I'll be there, and I hope to see you all with your smiling faces. I'm sure my smiling face will be there somewhere as well. And next month, as we said, we're going to be focusing in on, planning for children. But then the next month in September, I'm coming back, and we're going to talk a little bit more about the business insurance, but have a little more fun with it, a little bit more exotic, some of the unique ways that we have worked with various people with various plans, all including the use of a small business. You can see we'll November, October, and December what our other plans are. Hope you stay tuned and come back for those. And as Kathy said, if you missed one, they will be on our website. Other things we do, we are very happy to be sponsoring. Hopefully, you are all members of one or most of these, or two or three, and we're happy to do so. And we would love to be seeing you live when we're at your meetings. We have one other thing. That's us. So we got done with a minute to spare. Like I said, I'm sorry we couldn't get to all the questions, but we promised to get them all back to you, and we hope you tune in again next month to find out what happens to the Green family. So long. Oh, on Days of Your Life. I forgot it was. Green family on Days of Your Life. Bye.